Hey everybody, this is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for Tuesday, 24th day of February. Well, uh, net changes, right? May corn down 1 3/4 cent in a tight range. New crop beans down 3/4 cent in a tight range, a 3 cent range. The only good thing I can say about corn is that we've had a little bit of a rally. We've gotten dragged up a bit by soybeans and also wheat on the recent run up there. It was a very good short covering rally in wheat. We also had, over the past 2 weeks, 150,000 new longs on the spec side from the managed funds who are getting long soybeans. I hope they will buy another 150,000 next week. That would be really nice. That's what we need because right now we are at the top of the trading range. If you look at May beans, if you look at no beans, we are at the top of our recent trading range. So I'm not calling it top. I'm just pointing out facts, right? We started in November when May beans, traded below 1050. Then we peaked out um, on the November 18th at 1177 3/4. 2 weeks later, we were down at 1050 again. And lo and behold, we find ourselves up here once again at the top. So is this a roller coaster? Is this the third time the charm? I don't know. I don't want to be in a situation where if I own a bunch of beans, I turn my nose up at a $1.03 rally. So if you've got beans in the bin and you want to let them go, let them go. You're selling into a $1.03 rally. And okay, can we go another dollar higher? Sure, we can. How would you manage that? Well, if you're selling into a $1.03 rally, hold back 10 cents, 12 cents, 15 cents, and re-own those bushels on paper, but only have the 12 or 15 cents at risk. Don't have the whole dollar at risk. And if you can't bring yourself to make a cash sale, then get yourself a substitute sale, which is what a put option is. I sent out recommendations today before lunch because I want to make sure that all my clients, new ones, prospective ones, everybody else gets to see what I'm recommending. I did make some recommendations with new crop soybeans. I do have some targets for new crop corn. If we get there, we're about a dime away from those. Or we're going to take some action if Mr. Markets gets us up there. We have taken advantage of the rally in wheat. Both KC and Chicago wheat have had a nice rally, 7 month rally, especially if you look at the July contract. And so, while I'm not calling a top in those, we've hit some technical targets. So it's giving everybody a chance to do what? Make a decision, which is the last thing most people want to do because anytime you make a decision, you're worried if you're right, if you're wrong. But I don't mind rewarding 7 month rallies, 60, 70 cent rallies in wheat. You want to take advantage of that. And again, making a sale is not getting bearish. Buying a put is not getting bearish. What you're doing is managing the risk because if you're a farmer or producer, you are a net long speculator. So you need to manage that position. All right. KC wheat today did finish down 4 1/4 cent after we had about a dime range. Chicago wheat finished unchanged after about another a dime trading range there as well. Moving over to the livestock, green on the screen, although not violently green. April fat cattle actually finished down 15 cents, but for the most part, everything was slightly higher. March feeder cattle finished up 80 cents at 365.10. Everybody's waiting to see, can we get March back up to 370, 375? There's that old gap up there. We did get a friendly cattle on feed, but we are trading sideways to lower, right? So, you know, it's pretty easy if you take a look at this March contract to know that if 360 fails, we probably have some more sell risk down below. And if we can get above 370, then it's going to be another shot higher, and we'll be talking about new all-time highs if we can get up to that 380 level. So we are at a decision point, and since we don't know, and I don't make a living lying to people, telling you don't worry, we're going to go here, or don't worry, we're going to go there. Set a hedge, right? Take advantage of what the market's giving you. There's some fundamental stuff out there where the hurt's too small. We've got all-time cash highs. We've got all-time box beef, very, very bid. We hear about every day the risk of the strike coming out of Greeley, but that has not shown up yet. If that doesn't show up yet, then fundamentally the herd's too small and the demand continues to be good. And I read some stuff today that part of the reason that there's been a good surge in beef prices were people, stocking up before the big snowstorm on the East Coast. Hey, if whatever it takes, whatever rationalization you need to get through, that's fine with me. That just seemed a little bit sketchy to me. I mean, it's you know, at the end of the day, the herd's too small, and although we've been promised, a disaster from all the naysayers, in the economy continues to hold in. People continue to go and buy expensive beef. So that's been the surprising thing here, really, for the last 2 years, that beef consumption has not. It's pretty much been inelastic, right? If you remember eighth grade economics, it's been inelastic, which means it has not responded to prices increases. People just keep buying it, and will that continue? Boy, I hope so for all the ranchers out there. In the outside markets, crude oil, again, we're sitting here at 65 to 67. Um, No new news on the whole issue, what's going on with Iran. No bad news, so no news is good news, I guess. And if you look at where we are, this $66 level, it's very, very key. Not that long ago, when we first started bombing Iran back in June, we hit 78 bucks and change. Then at Christmas time, we fell down to sub 55 for a day. We went to 54.98, which was a 5-year low. So we've had a little bit of a bounce here. Is that going to continue? We will have to wait and see. We're kind of at a turning point here in the crude oil market. And why does that matter? That kind of rolls through everything else. It's part of the reasons we had the big run up in bean oil, and also a big run up here in um, diesel fuel. That heating oil, right? They're right back up to 275, 274, 275 in the heating oil contract, the diesel contract. If we poke our heads above 277, that's going to be a headline news. And again, it's just, it could turn tomorrow. So lots of volatility there. We'll see what happens. So, big picture, I think that the grain market is giving you a chance to certainly do something in the beans. We need more of, upside pull for corn. Corn is, despite all the good news, despite really good exports, despite Mexico pretty much coming in every week and just buying, our corn, and exports have been excellent. We can't trade out of this trading range. If you look at spot corn, that's the number one thing that I don't like about spot corn. We've basically been in a 40-cent trading range, really 35 to 40-cent trading range for months now. And yes, we're off the deck at 438, but we're not that far from the contract low, which is 421, which we hit last July. So defend what you can. Hopefully, we get some more follow through buying. We've had a little bit of buying in corn, but the funds are still short corn. If we can get another 150,000 soybeans bought, that may help to uh, pull up and support corn as well. So that's what we're watching here today. I did send out specific recommendations. If you're interested in that, give me a call, 312-638-8868. Look for my private client podcast. I'll be posting that tonight, guys. We'll dig into the charts. Take care.